Hello and welcome, everyone. My name is Jamaica Vandola, and I'm the Assistant Director of Constituent Engagement at the WSU Alumni Association. The Alumni Association is expanding our alumni career support offerings, including today's event, Cougs Connect, Spark 60, in addition to other events and initiatives. Watch for more information about these offerings. Welcome to the Crimson to Career Alumni Panel, Retirement Readiness for Cougs Mid-Career Professionals. During the panel portion of the program, for the best experience for all participants, we will take questions through the Q&A feature. We will monitor the questions and reply or ask our panelists to address them as time permits. To ensure optimal viewing experience, only panelists and moderators will be on camera and have audio enabled. The WSU-AA requests that all attendees show respect and professionalism towards our panelists and each other. An Alumni Association team member will monitor the chat, and action will be taken if necessary. Today's webinar will be recorded and available for viewing by visiting the Alumni Association's Video Archive Library. Check out the chat for the links. Today's webinar will be recorded and added to the YouTube following today's session. As we do before each program, we would like to acknowledge that WSU campuses statewide are on the homelands of Native peoples who have lived in these regions from times immemorial. The university expresses its deepest respect for and gratitude towards the original and current caretakers, pledging that forged relationships will consist of mutual trust, respect, and reciprocity. We encourage you to take a moment to reflect on the Native people associated with the area you might live and work today. So that we can jump right into the session, we're dropping a series of links into the chat to showcase some of the amazing things happening because of you, our amazing WSU alumni, students, faculty, staff, parents, and friends. At this time, I would like to introduce Max Baer, who will be serving as our moderator today. Max, CFP AAMS, is a wealth manager and partner at Merit Financial Advisors with more than a decade of experience in wealth management. After earning his degree in economics from Washington State University in 2015, Max began his career at Charles Schwab before transitioning to his current role, where he advises individuals and families on complex financial planning and investment needs. A dedicated Coug, Max served as WSU's beloved mascot Butch T. Cougar during his student years and now gives back as the president of the Butch Alumni Club. Please join me in welcoming Max Baer. Max?
Good afternoon, everyone. I'm so excited to be here with so many Cougs. It's always nice to get some big Cougs together, and I'm feeling the energy in this room, so thank you all for coming. Today's session is customized to the audience of those who are mid-career. We have a different session for previous career or recently graduated, searching for jobs, and then we have a different session for approaching retirement and in retirement. We'll link those in the chat. Additional information of those will be sent out in email, again, via chat. There is an important disclaimer. Please remember that this session is intended solely for educational and informational purposes. The information shared is general in nature and not individualized financial, investment, legal, or tax advice. So every person with their circumstances is unique. So before making any decisions regarding investments, taxes, or other financial matters, please consult with qualified professionals who can provide personalized guidance. Any views expressed by the presenters or me, or the materials shared by them as a courtesy do not necessarily reflect the views of WSU or its related entities. As we get started, I'm very honored to introduce our expert panelists today who are here to help us understand retirement. First, we have Bailey Erickson, CFP. He is a financial planner with quantum financial planning and is a proud Coug through and through. He earned his bachelor's degree from Washington State University, majoring in marketing with minors in economics and communications, and later completed his MBA with a concentrated in finance through WSU's online program. During his time at WSU, Bailey worked in annual giving for 5 years, helping launch Cougstarter, WSU's crowdfunding platform for student organizations, and was actively involved in the Greek community. Today, he helps individuals and families build financial confidence and plan for their future. bringing both professional expertise and a lifelong connection to the Cougar community. Everyone, welcome Bailey.
Appreciate it. Thanks for that.
Next, we have Eric Green, who should be joining momentarily. Here he is. Everyone, please welcome Eric Green, CFP AIFCKA. Eric is a financial planner, again with Quantum Financial Planning, and brings more than 25 years of financial management experience to his work with individuals, families, business owners, and organizations. A Washington State University graduate with a degree in business and accounting, Eric specializes in retirement planning, estate planning, and fiduciary guidance for corporate boards and trustees. He is a certified financial planner professional, an accredited investment fiduciary, and an active leader in the Spokane community, serving on the board of Union Gospel Mission and participating in several professional organizations. Everyone, please welcome Eric.
Thanks, glad to be here.
We are obviously all, me and the attendees, very excited to hear from our alumni panelists who specialize in retirement planning. Don't forget, everyone attending, if you have a question, there is a Q&A and chat feature at the bottom. I will do my best to monitor it, so throw whatever questions you have in there. And if we have time at the end, I'll try to give you a shout. Let's begin with a couple of questions to get to know both Bailey and Eric a little bit better. Bailey, let's start with you. Can you tell us about your journey to and since WSU, and then looking back on your early career, what is one financial lesson you wish someone had taught you sooner?
Yeah, appreciate it. So first and foremost, though, born in Vancouver, Washington, so kind of west side of the state there. And I think my kind of journey to WSU started right out of the crib. Essentially, my entire family went there. You know, mom, dad, aunts, uncles, grandparents, everyone except my twin sister, who went to UW for better for worse. But nonetheless, though, it kept Apple Cup, just an absolute great experience. And the sibling rivalry was kind of second to none there. And then ever since my time at WSU, I met my wife there my junior year, and then we got married shortly after graduation, and then been here in Spokane, Washington ever since, working with Quantum. And then from taking a look back to the early career side, there's a lot that can go into that, but I would definitely say the long-term financial success isn't down to necessarily picking kind of individual stocks or the right stocks, or kind of uncovering like any secret sauce as far as kind of what's that core financial lesson. Is that it really comes down to sticking to your long-term plan, then actually executing it. I think that a good plan is only as valuable as what you're actually able to go ahead and execute. So I just say make sure that you develop it. You don't need to overcomplicate it, but make sure that you follow through with it.
Thank you, Bailey. Wonderful answer. Eric, how about you?
Lived my whole life in the state of Washington. As a little kid over in Bellevue, that family moved to Spokane, where I grew up and graduated from high school. I was always going to be a WSU Coug, I think, even though my parents didn't attend there. My dad was the president of the Cougar Club in Spokane. I grew up going to football games, all kinds of events. So my sister and I were are proud Cougars. Since then, since graduating, I've had a number of different careers, but for the most part, enjoyed a career in providing financial advice to clients. Some of the volunteer things that I've been involved with, I've been a member of one of the WSU Foundation Plan Giving Advisory Committees. Love giving back and helping them in their goal to raise support for WSU and students and alumni.
Great. Thank you, Eric. Let's start our discussion on scaling your retirement strategy. Bailey, we'll start with you. As careers progress and income increases, how should someone think about scaling their retirement savings strategy?
Yeah, that's a great question, and one we kind of get pretty common within this kind of chapter within someone's financial journey. And I always come back kind of first and foremost is that, if available and cash flow supports it, diversifying the type of investment accounts that you have. And what I mean by that is that there are different accounts and they're each treated differently from a tax perspective, not only while you're contributing to them, but then also when you're withdrawing from them in retirement. So those can kind of range from, tax deferred, taxable, and then kind of tax free are kind of the top three accounts, I would say. So, like an example of a tax deferred account would be like pre-tax contributions through your 401k or 403b that most participants are pretty familiar with. And then you have tax free, which then that would be your kind of like Roth IRA dollars. Again, all of those coming out tax free later on in retirement, given that you meet some of the circumstances there. And then taxable would just be like non-qualified brokerage accounts or a brokerage account is what they're commonly referred to. And simply put, just having some diversification and options later on in retirement can really just give you a lot of flexibility. And then starting to contribute to some of those accounts, given your situation, can really have a pretty good impact later on in retirement. So, and then from there, I always say just consider increasing your retirement contributions each time you get a raise. So it's a really easy kind of just habit to get into before you're even starting to become accustomed to that lifestyle with that additional income. See if you have an appropriate ability or the option to then go ahead and just make even a 1% increase can have a pretty meaningful impact.
Thank you. And sticking with this topic, mid-career, cash flow is good. They're increasing their retirement savings.
Yep.
What are some common mistakes you see people make?
Yeah, I'd say kind of first and foremost is that not being aware that some employers will actually have multiple options for retirement accounts. Like more importantly, you'll see this with university employees or like nurses and doctors, and mainly those who work through kind of like hospital systems. But there's many other different career fields that this can apply to, so make sure to reach out to your benefits department and ask about that. But that just because you have a 401k or a 403b, you might have things such available to you as a 457, a deferred comp plan. Long story short, though, is that more often than not, there might be additional retirement accounts that will actually allow you to pack away more dollars for retirement. So again, making sure you're aware of that and that you're not just limited by one contribution limit. And then even if you are, you always have different options outside of those retirement accounts for some of those investable assets.
I like the breakdown of these accounts. This is super
Yeah.
helpful.
Yeah.
I'm also thinking about, people in this situation, they have so many choices for accounts. They also have so many decisions to make in their regular life. This could be part of the sandwich generation where they've got kids to take care of and aging parents to take care of. Maybe they still have student loans. Maybe they just bought a house and there's a big mortgage still. How do you balance those priorities?
Yeah, no, that's a great question, and it's becoming, I think, more and more relevant, especially as we started to get through the higher inflationary times, kind of given the last 5 or so years. It's not that things are getting cheaper; it's just that inflation is coming down, at least the rate of which the price of goods are increasing. So I always like to say, if you can develop an order of operations. It's kind of, basic as it sounds. We have PEMDAs. Please excuse my dear Aunt Sally from kind of, multiplication, early grade school days. We kind of have the same order of operations, at least from a broad financial planning, like, framework and kind of concept of, building your emergency fund first, then making sure you're contributing enough to get the employer match. And then from there, tackling like high interest rate debt. And then after you're able to cross that bridge, moving on to retirement accounts and maxing those out, and then kind of shuffling in and bringing in, okay, we need to think about, aging parents. Are we going to have to support them at this point in time? Or do we have kids' education to worry about? Or home improvements? Maybe the roof is going to be leaking. So I think that brings in the second half of that is that's all great and dandy if we have the cash flow to be able to kind of work through that order of operations pretty quickly. But that if you are going to have to make some adjustments to those retirement contributions, making sure you prioritize and be willing to adjust. And what I mean by that is that life isn't a straight line. So if you have to temporarily reduce your retirement savings, just understanding and making sure that you set a hard date to review that, to come back at a later point in time and either increase those contributions a little bit more above and beyond to make up for it, or be willing to work maybe just a little bit longer if life kind of comes at you from a curveball perspective. Yeah.
Thank you. And one last question for you, Bailey.
Mhm.
What if someone feels behind on retirement savings? Maybe they haven't done a whole lot of work, but their heart's in it. Where do you think they should start?
Yeah, and I think a really good kind of root of that question is that if you feel behind, make sure that that kind of sense of where you're getting that from is just based solely on your financial plan and your situation. Because, especially with how accessible things are and how kind of great things can look on social media or even the news, and you might hear these kind of benchmarks, is make sure that it's actually tailored to your financial situation. Try not to compare yourself to, let's say, the couple down the street who may have just bought that kind of nicer new car, or they're taking those vacations, but making sure that you're actually gauging it against your milestones and your goals. So if you are feeling behind, I would always say just make sure that you're working on paying off high interest rate debt. So anything kind of north double digit territory, so 10+%. And then from there, just don't limit yourself to maxing out your 401k. I mentioned earlier that there might be additional retirement accounts available to you. And then if you have that extra cash flow, you're able to pay off some debt, you're able to take a look at those milestones. Keep in mind too, is that once you hit age 50, there are also some additional catch ups to be had. And then finally, I say that there might be some sacrifice if you start to come back to, okay, we need to make sure that we're hitting our milestones. You might be a little bit behind. It really comes down to, again, if you receive like a bonus, it might be a good idea to save that instead of putting it towards kind of XYZ purpose that you might have in the past, or even maybe a tax refund, I think is a really good kind of opportunity to use some unexpected cash flow if you get some tax refunds too.
Thank you, Bailey.
Yeah.
And I do want to introduce one last panelist. We were having some technology issues. Lagwan, welcome. It's good to see you. I want to introduce Lagwan Mitz. He is a financial advisor with Eagle Strategies and brings expertise in retirement planning, insurance solutions, college funding strategies, extended care planning, and lifetime income planning. In addition to providing investment advisory services through Eagle Strategies, Lagwan is also licensed with New York Life Insurance Company and offers securities products and services through NY Life Securities LLC. He's passionate about helping individuals and families identify their financial goals and develop strategies to achieve long-term financial security. Lagwan graduated from WSU in 2012, where he played football for the Cougs. Since graduating, he and his wife, a fellow Coug, are currently living in Portland and just welcomed their third child. So Lagwan, welcome. We're excited to have you here. Can you tell us a little bit about your journey to and since WSU?
Yeah, absolutely. And thank you for having me. Thank you for having me. It's been a journey. Some would say it's a roller coaster. Some would say it's life, right? Um, After leaving Washington State, got some opportunities to work out with a few NFL teams and consider going overseas to play. But I was like, I kind of want to like start a career. And so many know that my dad played in the NFL. He was drafted by Seattle in '86 and played for 7 years, but respectfully, doesn't have a lot to show for it financially speaking. And so I wanted to get into financial literacy to some degree. My mom is in the Hall of Fame at U of O, shot put and discus, All-American, 2 times and all that. But, it doesn't really mean a hill of beans when it comes to financial literacy and the give back that people just don't have. They're not granted that in high school or college. Oregon just passed the SB3, which requires financial literacy for high school seniors, but nationwide, it's just not a thing. And so I got into that, giving back with a nonprofit, but also wanted to do it on the day to day and be able to give back and not just talk about, the bare bones of financial literacy, but also get into the wealth management side, where you can make some money, take care of a family, leave a little dynasty to some of these little gremlins, I like to call them. And yeah, just kind of have that dream fulfilled. But you can't expect somebody else to do it for you. You got to go do it. And so that's what kind of set me on that blazing pathway to pursuing the career that I have now and continuing to build that practice up so that I can one day pass that off to one of my kids potentially. So
thank you for the background. A family of athletes. Thank you for being here, loved one. Eric, I'm going to pick on you now.
Okay.
Let's talk about legal planning, like wills, trusts, other family updates. My first question is, what are the most important legal documents for any family to have, regardless of age or level of wealth?
That's a great question. In my years of doing this business. I've been a lot of things. A longtime member of the Spokane State Planning Council. I think I've been a different classifications. I've been a CPA. I've had an insurance license. I've been a trust officer. What else? I'm a certified financial planner, but one of the things I haven't been is an attorney. Um, I'm okay with that. There's enough attorneys in town. They don't need one more. But so some of these legal questions come up in financial planning all the time, though. So I would say some of the important documents that everyone should have, some for medical and healthcare reasons, others for financial and property documents. But everyone should have, I think everyone should have a last will and testament document. They might want to have a living trust document if that fits in their plans. They should probably have a financial power of attorney document. They might want a healthcare power of attorney document as well, a living will, and then maybe something for HIPAA that would take care of some of the medical decisions and sharing of information. There's a lot of important documents that an attorney can help clients put together.
Thank you, Eric. And I'm thinking about the way life moves, and sometimes it moves quite rapidly and in a volatile manner. So let's say that we created an estate plan, but life changes. What are some of those events that could trigger me or my family reviewing our estate plan?
Well, when the family changes, it could be adding a new family member. That could be through a marriage, might be the birth of a new child. So when the family gets bigger, that's a good triggering event. Also, when the family gets smaller, if someone passes away. I attended a funeral last week for a good high school friend. Going to another one, my dad's best friend growing up passed away a couple of years ago. So when families change, is a great time to be reviewing things. Marriage or remarriage, birth or adoption, death of a beneficiary, maybe a change in your representative. You've got in your documents, maybe you've named someone who's going to be you're asking them to take on a role. You know, if that person's situation changes, those are all be great reasons. Or if there's something financial that happens in your life, it could be some kind of a substantial inheritance or a windfall that you receive. And then also, not to say a small event, but you know, buying and selling real estate is also a good reason to be reviewing your documents and make sure everything that's in your life is included in your planning.
Well, Eric, I'm sorry for your loss, but that is a stark reminder how important these documents are. What are some common misconceptions that people have about these documents?
I think the one I hear the most often is that estate planning is only for the wealthy. That's not true. I think any adult, any responsible adult, anyone who is responsible or for helping ensure the care of another needs to take care of some estate planning. Also hear that another one is that if I have a will, that avoids probate. Well, that's certainly not true. If you have a will, you're going to go through probate. Or that, gee, I have a trust. That doesn't mean that means I don't have to pay taxes. A trust doesn't mean that the taxes are ever eliminated. Another one is, well, it's simple. Everything just goes to my spouse. Well, in a simple world, that's not true. Those are some common misconceptions regarding assets and wealth. Some legal myths like estate planning is a one-time event. I think estate planning is kind of a journey. Something that you might do in your 20s, but you should review it from time to time. It's going to your plans are going to change just like you're changing. And your family might be changing. The oldest kid should be the executor, maybe. I think the best kid should be the smartest, the best prepared, the most available. I mean, there are all kinds of reasons why which kid maybe should be your executor. Maybe none of your kids should be your executor. I think Bailey and I were working with a client here. The kid's definitely not the best executor, but that created kind of a difficult planning session to figure out who might be. It only handles what happens after death. Well, if you get injured or can't take care of yourself, who's gonna step in to your place if you're in a period of incapacity? So estate planning needs to deal with that if it happens. Joint bank accounts solve everything. No, that's not too. I'm too young to need a plan. Again, most adults, all responsible adults should have some kind of an estate plan and some documents. So those are some things that Bailey and I have heard working with clients, and I've heard throughout my career in different positions I've had.
Eric, how often should you review and update beneficiaries?
I think, well, again, as often as beneficiaries change, marriage, divorce, new children, children's situation changes. You don't have to do it. You don't have to do it every year, but people review a lot of things kind of on an annual basis. Maybe it's around New Year's time or around birthdays or anniversaries, but it's always a good idea to make sure that the plans you've made are still appropriate as life changes.
What if I update one part of my estate plan, but not another? So in this case, what if I update my will, but I don't update my beneficiaries, and then I pass away tragically? What happens?
All kinds of mistakes I've seen. Unavoidable that maybe were avoidable, where you lose track of documents, can't find them, they're locked up. Maybe they're in somebody's safe deposit, but the family member doesn't even know that there is a safe deposit or where the box is or where the key is. Frozen bank accounts, if it's only your name on an account and you pass away and there isn't a provision, the account's going to be locked up for a time until someone steps in and can make a decision to release that. Even though at a time when having your hands on some cash might be real helpful. In this era of so much is stored digitally, passwords and accounts. There's a lot of valuable information that you might want to be able to share with a family member, not just financial records, but all kinds of personal records. Where are those accounts? Where are those passwords stored? Who knows how to gain access? Sometimes asset designations that could have been changed. I've seen, unfortunately, a situation where an ex-spouse is still named as a beneficiary, whether in an insurance policy or in a retirement account, where beneficiary designations most of the time rule. How about the situation where you create a living trust? You go through all the work of creating a trust that you think is going to make things simpler for your beneficiaries, but you forget to put assets into that trust. To do that requires retitling most of the time, and if you don't follow through and retitle those assets and fund your trust, then the trust doesn't really work or accomplish anything that you were hoping for. I don't know, overlooked debts and liabilities. I don't know that do people really forget about what they owe and what they and their debts? I've heard that brought up, but I haven't seen that one too often. But as far as names and relationships, you might have someone named as the executor in your will, and that person's now gone or moved away. I mean, how helpful is that going to be if your executor can't do the job that you were hoping for? Verbal only final wishes, I want this kid of mine, I want this loved one of mine to inherit something, but you never wrote it down. It may not happen the way that you wished it to. And then this one's more common, I think, than people realize, to have backup beneficiaries on different documents. Sometimes the person that you're hoping that will receive something from you, something's happened to them in the middle, in the meantime. And so if that ever it should become the case, who would be the next in line? How would you want that passed on if the person you named isn't there ready to receive it? So lots of things to keep track of, and that's just a reason why it's important to, from time to time, review things.
Thank you, Edmund. I appreciate it. Let's get into tax strategy and risk management. One, how should someone evaluate whether to contribute to a traditional versus a Roth retirement account? Well, you're on mute, but I'm sure you're saying something really great.
Can you hear me?
I can.
Yeah, I said that's a really good question. I think the simplest way to frame it is, when do you want to pay the tax? With a traditional account, you may receive a tax benefit today and generally pay taxes when that comes out. But with a Roth, you're paying taxes today, and exchanging that for potential tax-free qualified withdrawals later. So I'd look at, your tax rate today and what you expect your situation to look like in retirement years, how long the money has to grow, and how much flexibility you want down the road. Because when you start talking about tax diversification, giving you different buckets to draw from, depending on your tax situation in retirement, is really the key to that question.
Do you think that there are tax planning opportunities that people in this segment either miss or maybe they make mistakes on?
Absolutely. Absolutely. One of the biggest mistakes, would be waiting until retirement to start thinking about retirement taxes. Those 5 or 10 years prior to retirement and around the beginning of retirement can really create some valuable planning opportunities, where some strategies should be put into place. And so it allows you to be able to manage which tax bracket you're in potentially. Some people not so much. But also decide whether, Roth conversions, if you've heard of those, make sense during some of those lower income years for yourself, and really coordinating how to recognize capital gains. Also, one thing that people mislook or don't take advantage of is an HSA if you're eligible, and really talking about strategically doing charitable giving as well. So the bigger point is not just of what you earn on your money, it's what you get to keep after taxes. So,
Good way to put that.
and also let me just add, I'm not a tax professional. I'm not a CPA or a tax attorney. So if you don't have one, I would definitely seek one in order to implement some strategies. But obviously, we do have oversight, being in the wealth management and financial planning arena, in some things that some CPAs are just not looking at, because they do look more so at the year-to-year basis rather than what are your taxes going to be looking like in 2041. What CPA cares about 2041 right now? So unless it's a business specific tax attorney, then they might look at that. But with all due respect to their professions, we look at some things from just a different angle. And that's why, as you make some more money, it's great to have multiple advisors in your kitchen. Not too many, but you do want to have multiple depending upon your financial situation.
I see a lot of clients so focused solely on investment risk and they don't ever think about protection risk. Like
Mhm.
one, what is a way or a popular way that people should start incorporating insurance into their financial plan?
I like to think of it this way. Investments are simply designed to help build the plan. Insurance is designed to help protect that plan. And so we spend a lot of time talking about, the market, the volatility, asset allocation, and investment returns. Everybody wants to talk about investment returns, but sometimes the bigger threat to a financial plan is something that's completely unrelated to the market. Somebody passing away prematurely, a disability, or a major health event for extended care. And so insurance is really about transferring that risk naturally to a company that you may not want, and most people don't want their investment portfolio um, or for the family to have to absorb and be a burden to them. So rather than looking at like insurance as its own separate conversation, I think it belongs along with the investments, the taxes, the estate planning, and retirement income for sure, as part of one integrated strategy, if that makes sense.
Yes, thank you. What are the different types of insurances that you see your clients most need?
Can one more time?
What are the different types of insurances that you find your clients most needing? Most of my clients only think about life insurance, but there are other types of insurance.
It depends from the individual standpoint. Definitely life, disability, long-term care. Business owners, that's a whole different concept and slew that I don't think we have time to get into. So I would say the life insurance, that's going to protect people who depend on a financial contribution, if they're no longer here. Disability insurance protects your income naturally. A lot of people think that, disability is for everybody that's 55, 60 and up. Fact of the matter is, there's some of my former teammates right now that can't get long-term care insurance because of some of the surgeries they haven't had or some that they have had that's restricting them from doing various things in their day-to-day operation. So, all types of coverage can, I guess, help protect the assumptions that your retirement plan is built on, the continued income, the continued saving, the financial security for those people that depend on you. And so I think that those are the big three that are overlooked. I know everybody hears about life insurance. Some hear about disability. Most people 50 plus, 60 plus hear about long-term care from a family friend or coworker, but do they pursue it and understand it so that they can get an adequate amount for themselves before it's too late?
Alana, how do you start to determine how much life insurance coverage a client might need?
I mean, really, that comes down to potentially their income is a big factor. Um, the value to the household, sometimes somebody is very valuable to a household, even though they may not have an income. They may be a stay-at-home parent. Well, if that person passes away, okay, are you getting a nanny? Are you hiring somebody on full time to watch the kids, take care of the house? A homemaker has some serious value, right? And then the time horizon. Somebody that's 25 and anticipated to work a full-blown career. Okay, if we're talking about 65, 67, it's 40 years. Them replacing their income is going to be a heck of a lot higher number than somebody that is 55, respectively. Now, that 55-year-old may naturally be making much more than a 25-year-old, of course, but the time horizon that they're going to be making that income is only for another 10 to 12 years. So when it comes down to that, it really comes down to the income, the vision, and what they're trying to do. A lot of advisors don't listen to their clients. And so people are like, "What's your pitch?" I don't have a pitch. And if the Xfinity or Comcast is freezing me, blame them, please. But you have to ask a lot of questions as a financial planner and advisor in order for us to do our job adequately and effectively. Um, People want to dive into premiums or how much they should be saving or spending in retirement. I'm like, you haven't even saved anything. You ask a lot of questions, and that's what gives us our answers to navigate through the spaces. But financial planning is something that forces people to think through the right issues rather than just the emotional ones.
Well put. Bailey, back to you. How often should people review their plans and why?
Yeah, I kind of simply put, as Eric said earlier, is just I'd say the most important one is as life changes. That's kind of the first kind of blanket statement I would say. But most people fall into a pretty kind of systematic rhythm. So sometimes that's annually, others that's semi-annually, from that kind of perspective. And then I always say that the next one, again, is as life changes. So Eric mentioned, marriage, divorce, new child, job change, inheritance, home purchase, all of those different things are going to trigger kind of different financial needs, whether that's going to be, cash flowing out from, taking care of elderly parents. Maybe we have kids going through college and we have to, again, adjust some of those retirement savings. We know that the financial plan is only static for what we know today. And that really kind of the only guarantee, when we talk about financial planning is that life is most likely going to change. The assumptions we have today, we think that financial plans are simply put, they're living and breathing things. So do what you can to at least get it set on the calendar. So maybe that's incorporating it with tax season. So as you're kind of gathering 1099s, you're getting all the documents for the accountant. Maybe we take that as an opportunity to just review where everything's at. It could be open enrollment. It could be, by the time you maybe get your tax refund. I've seen other people do it to where they'll do like a Sunday savings, or they'll maybe celebrate and say, hey, if we've hit all of our financial milestones, we can finally book that vacation that we have budgeted, but we actually don't want to execute on that until after we've reviewed our plan. So I like to say is do what works best for you. But yeah, an annual cadence or kind of semi-annual is what most people will fall into.
Thank you, Bailey. Eric, what conversations should people have with their loved ones?
It's a pretty big question, isn't it? I think if you love someone, first of all, tell them you love them and do it often. But you may have, let's say you got 3 kids. If you love them all, that doesn't mean you have to treat everyone the same. Maybe one's got different needs than the other. Maybe one's got resources in their life that the others don't. So if you love them all equally, that doesn't mean you have to treat them all equally. Some people, I think, I've seen that people get hung up on that a lot. But treat them uniquely based upon what they need. I would tell my kids who I love that we hope to provide for them, but tell them what your goals are, what your goals still are. I've got lots of goals that I still want to accomplish, and my kids are only part of that. They're an important part, but we've got other things my wife and I are planning on, and that includes playing things forward. Charity is a big part of that, and they should know that that's an important part of who we are as parents. That they're not just going to get everything, maybe. So, but whatever your plan is, talk about it. Don't leave it just written down for some attorney sometime in the future to get out and read to them when you're gone. Include your loved ones in your planning. You don't have to tell them everything, but tell them the important things and talk about it.
Well said. Thank you, Eric. Juan, how do you incorporate your values into your retirement, financial, and estate plan?
I think a financial plan should reflect what matters to you the most to you, and not just what you own. When I think about values and basing planning around that, it starts with questions, like I mentioned earlier. What do you want your money to make possible? Who do you want to support? What kind of legacy do you want to leave? Are there family priorities or experiences that are especially important to you? Those can shape everything from how much you save, and spend in retirement to charitable giving, the education funding, estate planning, etc. And so the goal isn't simply to accumulate the largest number, it's to make sure that your financial decisions are aligned with the life that you want to live and the impact you want to have. To me, that's when financial planning becomes much more meaningful, simply. And a good financial plan tells you what you can afford. A great one reflects what you care about.
It's a good soundbite. Well, thank you, Bailey, Eric, and Lagwan. We do have some questions from the Peanut Gallery. Lagwan, first one's for you. Assuming there are no known health issues, is there a sweet spot about when to purchase long-term care insurance?
The sweet spot would
Sweet
be
spot.
whatever age you were last year. The average age that purchases it is 58. If you are healthy, you can get it up to 79. I don't think anybody's going to like those premiums. I would say the numbers start jumping up significantly enough between 57 and 62 every year that you get older, even if your health is the same as when you were 45. That'll impact some premiums significantly.
Thank you. Eric, how should someone balance saving for retirement with other financial goals, such as paying off debt or supporting children?
Well, if I was the bank would put themselves in first place. If I was the kids, I'd put that they put themselves in first place. But since you're asking the owner, I guess after death and taxes, I guess that I would hope that they'd have a a place in that. It's impossible to that's an impossible question to ask an audience. But I think it reflects who you are. I don't think as parents you're going to change a lot. If you've done it, if you've worked your whole life or adult life raising kids or helping them along the way, I'm sure you're still going to help them. They'll still want to be part of your planning in the future. So one of the common things I hear in retirement is retirement's kind of divided up into 3 time periods. You got go, slow go, and no go. So I hope as you're balancing things out, you don't realize that you should do some things while you can, while you're healthy, while you're interested. Include your family in those things. Spend money on experiences, not stuff. But that's a lot to balance. I don't know what the right advice is. Everyone's situation is going to be different.
Bailey, we just got another question from the crowd. Can you talk a little bit about portfolio fees and what are staying? Should I expect the structure to evolve as the value of the portfolio increases?
Yeah, definitely. Great question. And I would say to answer your question directly, yes. I would expect kind of those fees to change, especially as portfolio value increases. I'd say definitely within the industry, there are a couple of different ways to charge on portfolios. Traditionally, you'll see kind of upfront commissions. That's essentially when like a portion of the dollars invested are kind of taken and used to kind of pay for like advisory fees. And then from there, it's a pretty more straightforward structure. Or you'll have ongoing asset under management fees. That's usually kind of the most common, I would say. In regards to portfolio or investment management fees, they also refer to it as AUM or assets under management. The typical kind of industry standard is, I would say, around 1%. There are definitely advisory shops that are lower than that. There's also just firms that will do investment only management. They won't do any financial planning. They won't do any proactive tax planning, like estate planning or review. And they'll just exclusively narrow what they review and do, and then they'll kind of charge accordingly to that. And especially as the portfolio increases, you'll see firms and advisors kind of tier off how much they charge from that percentage. So it will usually go down the more that the portfolio balance increases. Yeah.
Bhagwan, what aspects of retirement tend to surprise people the most as they retire?
What aspects of retirement tend to surprise them the most? The distribution phase. Definitely the distribution phase. Collecting their income, not knowing when to collect it. Collecting Social Security at 62 versus 70 can significantly change your overall income if you live to age 80, 85. There's obviously a sweet spot in there depending on what somebody's going to be bringing in. But I would say being very mindful about when you pull Social Security or your pension, and or any of your other accounts, whether it's pre-tax or after-tax money, is something that people definitely overlook and need help on so that they do it strategically and effectively. I had somebody, one of our fellow Cougs, that was giving back to the university and athletics both in a very scaled capacity. And I was like, I don't know what your financial planner was doing a few years ago, but did you guys talk about taking your IRA money and doing some charitable contributions to the school or to the athletics? Because you're sitting here just giving them cash when you don't plan on touching this IRA money. And so a lot of people don't know that, okay, especially when you start talking about RMDs, required minimum distributions, like you have all these capital gains in these accounts, and you can gift this and have a deduction on your taxes for that given year. And then whoever you're giving it to can essentially liquidate said investments the day after they receive it. It's like a double plus. It's a double positive for the receiving and for the giving party. But people just don't know about these very simple strategies if they don't have the conversation. And some people have to be open to it as well.
Bailey, what is one retirement planning mistake you see people make most often?
Yeah. Well, we just kind of got done reviewing a lot of clients' tax returns. That's something that we do kind of here on an annual cadence. And again, depending on some of the strategies that you're implementing, I always go back and a big advocate of double checking, not only that it was executed correctly, but that it also gets reported correctly on the tax return. Specifically, if you are doing like any backdoor Roth contributions, again, if it's applicable, you stay under certain reporting guidelines, and then you also work with a financial professional to do it. The final kind of stop along that journey is that it gets reported correctly on the tax return. And then there's actually supporting documents that you need to make sure are essentially given to the IRS. So that's actually kind of one of the most common ones that we see kind of at the moment with kind of what we're at with our annual cadence, I should say. So.
Eric, one more for you. What are some ways to gradually transition from full-time work into retirement?
I suppose it certainly matters what type of work you're doing. Some people have their career, their work requires a hard stop. But there are a lot of careers that allow you to flex to part-time. I've got a good friend right now who retired. It was well planned for, but his company just couldn't let him go, and they hired him back as a consultant. It matters what you do. I mean, if you're an NFL football player, you're not going to be doing it you're not going to be doing it much at age 59 and a half. I mean, there's only a few maybe who could ever do something like that. So I guess the answer is it depends, but I think an important thing for everyone is when you're considering it is not just what you're retiring from, but spend some time, spend a lot of time, spend a lot of conversation figuring out what you're going to retire to. That makes the change a little easier if you can see where you're going instead of just waving goodbye on that last day.
Thank you. I've got one last question, not financial related. When you guys make it back to Pullman, what is that one restaurant you have to eat at every single time you return?
Cougar Country.
Yeah.
Or Thai Ginger.
If I could go Tin Tans, that's kind of my go-to, and get a California burrito.
Aaron?
I'm sorry. Well,
When you return to Pullman,
yeah.
what's your favorite restaurant to return to?
Oh, I hardly ever get back to Pullman that I don't stop at the Coug.
Good answer.
Touche. Touche.
That was great. I appreciated this. I had fun. I think all of our panelists did too. I think our attendees really appreciated all the things that you said. So, Eric, Bailey, Laguan, thank you so much for sharing your knowledge and expertise today. As we close, all of your attendees, please think about this. At least for me, I always try to write down one thing that's actionable and I can get to right away, because if I don't, I forget all of this. And then in a year, I don't know what to do. So please take this time, think about what we talked about, and write down one, maybe three things for you guys to do. Following this webinar, you will receive an email with the links from today's session, along with a survey to provide feedback on this event. That's really important to us. We want to make sure that this is, one, good for you guys, good for Washington State University, and fun for us as panelists. We are always trying to improve, and we are coachable, so please give us feedback. There are also various resources to serve as guides as you navigate your plan towards retirement, and a link to the recording. We appreciate you sharing your input. We hope that you found this session to be educational, informational, and practical, and we hope to see you in the future. Go Cougs!